I should push got it, I guess, right?
Yep, here we go. All right, we are now live. Hello, everybody, and welcome to Flipping Fabulous. I am your host, Jacob Jennings, your favorite flipping fabulous real estate broker in South Florida. And I'm joined today with my very special guest star, Mr. Tony Acquaviva of Premier Lending. How are you, my friend?
Very well. Thank
Premier
you,
Mortgage
Jacob. Nice to be
Associates.
here.
I always get one part of your introduction tongue-tied, but Premier Mortgage Associates.
Correct.
Got it. I always say Premier Lending because you're in my phone as a lender. So that's funny. I get it now. So, Tony, when did you start Premier?
Well, actually, that's a loaded question, and it's simply because I started the company. The company's legal name is NP Inc. And the DBA for the retail division has always been U.S. mortgage of each individual state.
Dear God. Okay.
However, it became a compliance nightmare once we started getting licensed in multiple states. And now that we are licensed in 48 states, it has become a complete nightmare to monitor 48 different websites. So we decided to change the DBA from U.S. Mortgage of each state to Premier Mortgage Associates, one name nationally, so we only have to manage one website now.
Well, that sounds like a lot more sense to me because I'm only one person, but you have a very large team.
Yes.
And I love everyone I work with. I work with John Deming quite a bit in your team. He's very good. And I have to say, the thing I really enjoy about the people that you work with is they're on it. Like I say, hey, I need to talk to somebody. I get a phone call in 2 minutes asking out the details, and then they reach out. So well done.
And remember now, John Deming is part of First Trust Mortgage, which is our Balustrade specific division of lending.
So that's why I get so confused. So y'all, either way, we got brilliant people for your lending services involved, which is why I wanted to frame this conversation with Tony here. You see, he knows so much more about the national lending platforms that are out there right now. And you're based in Florida, correct?
We are based in Florida, but yes, we have offices in 37 states.
That's amazing. And just when I feel like I am an underachiever, I speak to Tony and it's confirmed. So I'm only in 3. So anyway, what I wanted to do today, Tony, is to tell people about some of the big changes that are going on right now in the Florida real estate market. As everyone is, most everyone is aware, we're seeing the market shift. Days on market are increasing. Sellers are having to give some concessions. It's still a seller's market right now, but buyers are starting to get some foothold. But there have been some programs that have been implemented throughout the state of Florida that are trying to encourage buyers to get into the market now and to make the buying power, to help them with their purchasing power and get them into home ownership. We spoke last time about the Hometown Heroes program here in Florida that was designed to help first responders initially get into home ownership, but there have been some changes with that. So Tony, would you mind telling people how did the Hometown Heroes Act come to be and what has changed in the past few months?
Absolutely. Well, that question has a multitude of variations to it. So let me break it down for you to make it a bit easier. The Hometown Heroes program was initially designed to help during COVID first responders purchase homes here. So the attraction was designed to get people in those fields to move to Florida and have the luxury of having some kind of governmental financial assistance with the cash that they may need to purchase a home, because first responders, which broadens that category somewhat, it's not just a fireman or a policeman, but it falls into nurses and doctors and other areas of medicine and fields. So now the state became more attractive for people who may wish to move here if they were in one of those fields. And they realized that they set aside a certain amount of money, of which much of it was not utilized. So the governor had made a conscious decision to broaden the guidelines for the product. So what he did was he opened it up, which is now effective July, where anyone working full-time for a corporation in Florida is now eligible. So, wow, Jacob, you have broadened the borrower potential and opportunity dramatically, because Florida is not only home base for many companies, but many out-of-state companies have locations in Florida, which makes them eligible for this program. They have additionally increased the potential from $25,000 in assistance to $35,000 in assistance. So they've made two major changes. Now, they've also done some designations where they're designating a conventional loan versus an FHA loan. And the reason for the designation is they've created separate guidelines for each product. For example, where you might fall into a specific guideline for a government loan, they've now made it where you have a similar opportunity on the conventional side. For example, you can have a 640 credit score,
Okay.
and go on a conventional loan up to a 50 debt ratio if you get an eligible approval through the automated system. If you tried to take a traditional conventional loan with a 640 score and run it through DU with a 49 back ratio, the likelihood is it's not going to render an approval for you.
Say that last one more time. I'm processing.
There are specific guidelines when you're obtaining financing. One of them is your credit score and your debt ratio,
which is pretty typical in traditional lending.
In theory, it is, right? If you're over a 45 debt ratio, it might be more difficult. And if you have a lower credit score, it might become more difficult. So now the conventional guideline has lowered the credit score requirement and increased the debt ratio requirement, making it easier to potentially qualify.
That's actually really exciting.
It's so very exciting.
And 50%? Is that what it was?
But now you must render an approved eligible through the automated system, but the opportunity is still there.
And the automated system, and correct me if I'm mistaken, because I want to make sure I'm getting this correctly. How do they find the automated system? They have to go through a professional like yourself, correct?
That is correct. It's called direct underwriting, and it is Fannie Mae's system to automate underwriting. You run the file through the DU, and DU renders a decision as to whether or not it likes the file to issue an approval, a suspension, a denial, etc.
Okay. And do they give you, with that process, do they give you specific reasons why someone might be denied?
Often they do. It's broken down when you read the direct underwriting guidelines or the outcome. It will break it down based on income, assets, credit, and it will try and give you some guidance as to why it rendered the decision it did.
Okay, that's fair. That's fascinating. So at least they give you an idea of what to work on in case you are denied. Now, if you're denied, are you able to reapply at a later time?
Absolutely. You can only have one opportunity to utilize the Hometown Heroes program. But
one time to apply or one time to use it?
One time to use it. In other words, if you've gotten one, you can't sell that house and then reapply and try to get it again. It's one time.
Okay.
However, if you're utilizing it, the money that you're granted based upon what you're approved for never has to be paid back until the home is sold or paid off, which is a tremendous benefit.
And I really like the interest rate. What's the interest rate, Tony?
Basically, there is no interest rate. You're getting the money until.
Are you telling me? But you're telling me, Tony, that everything is going up in value. We're seeing 6% and 7% interest rates, and the feds are ridiculous. And there's no money you can't make any money in real estate. What are you talking about? You mean there's very little to no interest in this program?
Because the government specifically the state government, is trying to create opportunity for people to want to move here.
Now that's pretty powerful. But what I want to say to this for individuals who are listening, I do a lot of work for people who are trying to break generational poverty. Either they're immigrants to the country or they've never had, they'll be the first homeowner in their entire family. I deal a lot with homeless youth who are trying to get on their feet. And so I see a lot of misconceptions about homeownership. Now, this is the thing. You do need to develop the mindset to become a homeowner. It's at the top of Maslow's hierarchy. It's not something you're going to go into when you are just learning how to feed yourself, mind you. But what this is enabling people to do is, instead of waiting to have like the perfect 750 credit score to apply for quality mortgages, well, it's much easier to go from nothing to getting to a 640 credit score, which is much more attainable. There are strategies for that. And you're able to use that credit score. If you keep the right debt and credit issues there, you can debt to credit ratio, you can actually get into a home and then really start seeing generational wealth start to accumulate. So that's incredibly powerful. And now, is this available for just first-time home buyers, or is it available for everyone?
Well, in theory, it would be available for anyone who works full-time for a Florida corporation, but it's likely been designed for someone who's purchasing his or her first home.
That's fantastic. So say we have someone purchasing their first home. In this example, it's a single family residence, and they are in their late 20s, early 30s. We'll say no family. Okay, it's just maybe a couple buying a property.
Uh-huh.
They qualify for an FHA loan.
Yep.
How does the Hometown Heroes program fit into this?
Well, it's a little tricky in that the Hometown Heroes program is very specific to the city that the person is choosing to buy in. And why am I saying that to you? I'm saying that because there are specific tracking numbers that have to be reviewed and looked up based upon where the borrower is looking to purchase. From there, you have to calculate a certain percentage of the median income, make sure that the borrower falls into that category, and it is from there that you will be able to determine how much eligibility the borrower has.
So it's up to 35,000 when all these other factors are included.
That is correct. That's right. It might end up being 10,000 for one borrower and 35,000 for another borrower.
Based on where they're located, the median income for those professions.
That is correct.
Demographic. Okay. So how long do they have to own the home? So say someone comes in, they buy the house, and typically, if they own the home for 2 of 5 years, or they live in the home for 2 of 5 years, it's considered their primary residence, and capital gains are different in that situation versus a flip scenario. Does the length of how long someone lives in that home, does that affect anything that they have to pay back to the Hometown Heroes? Does it increase their capital gains? Can you talk about that?
Once they sell that home, if they choose to sell within 2 to 5 years, they have to pay back the amount that they received upon the sale of the home.
Now, does that also qualify if they choose to keep the house, refinance it, and turn it into a rental?
They have to then pay it back with the refinance.
That actually makes a lot of sense when you consider it, guys. There's a finite amount of money in this program, so eventually it has to be replenished. And I think that's a very smart stewarding system.
And making it available to someone else.
Exactly, to help pay it forward.
That's exactly
Make it good for everyone. So if someone is able to get in there and they do qualify for, let's say that this couple buying this house, let's go for, it's a 3-bed, 2-bath in someplace like Boynton Beach, Florida, which this is as middle America as I can go, y'all. So use this as your example.
Okay.
If they're doing that program and they qualify for $10,000 in assistance, does that money go towards their down payment? Does it go towards rehab? How can they allocate those funds, Tony?
In theory, the money is going toward down payment and or closing costs. Clearly, if it's $35,000 and they have 5 or 10,000 of their own money, they may wish to apply more of it toward the down payment to lessen the loan amount to potentially have a lesser payment. or
Mm.
they may choose to utilize what portion they can for the down payment and the balance toward closing costs and not use any of their own money so that they potentially have cash reserves should they have a refrigerator breakdown or need to buy furniture or what have you. They'll have their own funds to do that.
So what I want to do is I want to talk about how that's effective, because you just touched on something very important, and I want people to see this. Let's say that you have purchased a home for $500,000. This is I'm a dancer by training, so my numbers like to be very rounded and in multiples of five. Okay, so
Okay.
let's go with this. So let's say you have a $500,000 home, and we are going to put down the FHA mortgage requires 3.5%. Is that correct still?
It is. But
So
the
let's.
only problem is that,
Mhm.
okay, I apologize. I might be jumping the gun, but that's too high a sales price for an FHA loan. Did you intend to do it that way?
Yes, just for number's sake.
Go
This
ahead.
is this is that yes, but we'll come back to that. So and I know there are higher limits on conventional. So we'll touch on that in a second. Let's make a note to come back to that. But what
Okay.
I want everyone to see is the strategy here, okay, and why this is really cool when you do it the right way.
Mhm.
Out of 500,000, 3.5% is $17,500 that Joe and Sally had to put down to the purchase of their home. Now, they also qualified in this example for $10,000 of down payment assistance. They've got two options now. They can either come to the closing table with $7,500. Tell me if I'm incorrect here. Or they can apply the $10,000 up to the full amount and put down $27,500, which means they're only being paid interest on the life of their loan for the balance thereafter, because that $10,000 they got was interest free. Am I correct in this?
You are correct. However, when you say they only have to come to closing with that much money, I think you want to mention that they still need sufficient funds for the closing
Closing
costs
costs.
and
Yes.
the prepaids.
And thank you for being on top of that. I'm trying to show people, and yes, that is absolutely correct. This is the value of having a real estate strategy with you. So when you're going to purchase property, and especially in this turning market, you don't just want to think, okay, this is how much I've got to come down with. You do have closing costs to consider, and that's what this program does come to the table with. Roughly, I like to calculate about 9 or 10% when I'm doing my closing costs to be conservative, but this helps a ton with that. So if you're trying to put together your investment strategy, and your primary residence should be a part of your investment strategy, you need to know, here are the products, how do I best allocate it to get to my end goal? And if you're partnering with different loan programs, FHA, conventional, things that might be like all-in-one mortgages, so on, it will help you get to your financial goals when you think strategically. Go into purchasing your primary residence, understanding it's going to be your first purchase, now your only purchase, and set yourself up to win. This program might be an incredible tool for you and your loved ones as you go into getting into real estate and buying your primary residence. So I wanted to ask real quick, you've already answered how long they have to hold the property, and it sounds like it's the same as any other time. When they sell, they got to pay the loan back. It's city specific. It's medium income specific, and it has to be approved through direct underwriting, which is an automated system under, is it Hutton?
Fannie Mae.
Fannie Mae. So let's change the conversation from single family home to condos. Before we talk about condos and how to purchase condos in today's market, I'm going to ask Tony to weigh in on the Surfside Act that is now passed in Florida. Tony, can you give a brief overview of what happened to cause the Surfside Act to be implemented?
Of course, but I want to clarify for you just so that we don't miss anything for any consumer who has interest. In addition to Fannie Mae, Freddie Mac has an underwriting system as well. It's called LP, Loan Prospector, and that too is an outlet for the Hometown Heroes program. Because remember, I shared with you that there's a government FHA opportunity. Then there's also the conventional, which could be Fannie Mae or Freddie Mac. The only reason I emphasize that to you is each one of those automated systems have different criteria that they attract or draw toward or after when they're underwriting the file automatically or automated. So you might
They look
render
for different things.
an approval with one that you might not get with another.
And do you find that out at the same time
Well, if
when you apply?
you don't have success under one, you have the opportunity to run it through the other platform to see if that renders a different outcome for you.
Got it. Okay, that makes sense. So there is hope. If you don't get one, you might be able to get the other.
That is correct. So
That's
now
fantastic.
going back to your condo question. So what
Website.
actually in a nutshell happened in North Miami is the building required some structural renovations. And the members of the condominium, in theory, fought the association not wanting to raise their dues or have any form of assessments. So the board seemingly succumbed to the requirements or requests of the members and didn't allocate the funds nor collect funds to do the repairs. And so what happened is, as the building started to deteriorate, the rebar that holds the building, the cement together, was starting to rust, and inevitably it lost its footing and collapsed. So the new regulations now state that certain requirements have to be met, of which one of those requirements is a case study has to be done on every single condominium, and it has to outline what needs to be done on the building, and it gives a specific period of time that those specific requirements must be met. Now, the bad news is,
and I also want to point out that, and not to interrupt you, I apologize, but the reason why this came to be was so many, over 90 people lost their lives in that collapse.
oh yes,
There is the tragedy, and the tragedy took loss of life, which is why we have had to enact a very overdue legislative change. So I want to make sure we cover that as well. And so saying that, please continue.
yes. So now what's happening is, by December of 24, virtually every condominium in Florida will have met the requirements, of which any structural work that needs to be done on a building will have an outlined pattern of repair, and the buildings will have sufficient funds to complete those repairs. So until December of 24, there will be some ongoing renovations, rehab, etc., that's taking place on different condominiums. But technically, by December of 24, every condominium in Florida should now meet all of those requirements, which would make them considerably easier to finance, because any of the potential issues that arose or could have arisen will now likely be squashed and cared for.
So I'm going to tell a little story about that to make sense of this. When I bought my first condo, we were not able to get FHA approval because there were literally like only 3% of all condo buildings anywhere in Florida had reserves that would meet FHA requirement. They were very stringent. So we were able to get a conventional mortgage, which allowed us to put 5% down at that point in time when we were buying our condo. It was our first home. It was great. Now, we learned a lot through that process about what it means to have reserves in a building. Let's make this human for a second. Living in South Florida, we attract a lot of people getting a vacation home, a second home, or a retirement home. And a lot of these senior citizens that get retirement homes are living on a fixed income. So they get a condo, they live the good life in Florida, but they don't have tons of extra money coming in to pay for these new assessments that are required by the state of Florida now. So what we're seeing is we're seeing condo sales start to stagnate. They're staying on the market longer. They're harder to get closed because there are assessments that have to be done, as Tony is saying, to make sure that the roof is funded when it needs to be funded, that the foundation repair is set up and planned for and will be funded when it is funded. When they have to do something called an MSI for structural integrity, they have to make sure that those are ready and funded as well. And there are different things that are addressing condos that are 3 stories and higher, but all condo buildings are affected, even those under 3 stories. So just be aware that there's a lot of it's a little muddy right now for condos. I would say it's just challenging at the moment. So we're seeing a new crisis in housing as we're trying to repair something that was never addressed, and giving and HOAs had the opportunity to ignore warning signs and not fund reserves, and they were acting, frankly, irresponsibly over time. But I don't want to smack anyone and sound negative that way. I understand, especially in so many of the buildings that are 55 and older, that funds are tight already. So coming up with the extra money to fund these reserves was probably challenging enough as it was. That being said, we now had to come up with a way to fix this problem. How do we help these seniors who are not able to afford to live in the condos that they have been in? And how do we fund the reserves for these buildings that need to be repaired so we don't have more loss of life? So that's kind of the balancing act that's going on right now. In my observations as I've been going around showing condos, because now they're looking more favorable price-wise, but then you go in there and you're finding that your HOA fees are like double what your mortgage would actually be, and there are all these special assessments. Can you talk real quick, and because I have another point here, can you talk real quick about some of the limitations that we're finding with lending when it comes to having repairs scheduled to be done on a building versus having them already completed when it comes to getting lending for condos?
Sure. And let me clarify for you. You mentioned the differentiation between providing financing on a condominium for an FHA borrower versus a conventional borrower. So when you finance a condominium through the means of FHA, you have to do what's called a spot approval, which is basically a one-time approval each time you try to finance a unit using FHA financing in a building that is not FHA approved. And
Okay.
FHA's requirements are more strict because FHA has a specific clause in their guidelines that says you cannot discriminate. So for instance, if you have a condominium that's 55 and older and they don't allow for anyone under 55, you'll never likely get that approved as an FHA condominium, because in theory, an over 55 building is discriminatory in the eyes of FHA.
I happen to agree with that statement, but continue. I
That
agree.
would be the theory, right? It has to be open to all people. Now, as far as your question related to buildings that have structural integrity issues, and issues, even though it's simply said to be a roof repair, in the eyes of the government now, a roof repair is a structural integrity issue. So if the building is in the midst of having the structural issue repaired, you are not eligible to close and finance and fund the loan until the structural repairs are complete. Now, if you have other issues, for example, a slip and fall lawsuit, something that is unrelated to the structural integrity of the building, you can overcome those obstacles by simply getting a letter from the law firm and or the management company that validates that the insurance company has sufficient limitations to manage the requested potential lawsuit if the building were to lose. Anything related to structural integrity, you're not going to have the luxury of providing a letter. You literally have to prove that everything is complete before you can close on the loan.
Okay, you just gave some really good notes that I really want to talk on. That's really interesting. I hadn't thought about the lawsuits with, if anything, had There was a lawsuit against the building for negligence of some sort. So
Which is not uncommon these days.
we're in a very litigious society, especially in Florida. And
Yes.
why what you said is so important, I want to bring up, is Florida has become very, how do I say, lawyering up happy, like like legislatively happy. They want to sue everybody for everything. And there was a period of time where the insurance companies were having to pay out so much and these legal fees with all these cases that came up, that it became a detriment to their company to stay in Florida, which is why so many of our insurance providers have left the state. Like, they're gone. We don't have many insurance providers for housing here. I think we have Citizens. I think that's it, if I'm not mistaken.
Well, actually, DeSantis passed a new law recently where you can no longer sue an insurance company without paying fees for it. His purpose for initiating the new law was so that people can't just randomly start suing left and right without making certain that they are participating in the cost. So where an attorney would have taken your case previously on a contingency and hoping that he or she won, now the borrower is going to have to put money up to file that suit. So you may find, Jacob, that fewer lawsuits will be filed now, because when people are filing frivolous lawsuits, and I'm using that broadly, they'll now think twice about it, knowing that they're going to have to put up money to make that possible. With that, it was assumed that with this new ruling, our insurance premiums would lower. So now we're waiting for that part to take initiative and it take its place, because the cost of insurance, and it is not only Citizens that we have from which to choose. There are many insurance companies still available. It's just a matter of the affordability of the insurances that are available to us. So we're hoping the new law, as much as it doesn't necessarily benefit the consumer, the objective will be that it will benefit us because our cost for insurance will decrease.
So that was a very smart move, actually.
We hope. We are waiting for the results.
It's interesting. I think that does make sense. It is consumer friendly and it also is responsible. So we'll see where it goes. So this is something I'm going to talk about real quick, because you just said something that was really interesting, like how to close while structural repairs are ongoing in a condo. So it makes sense that when a lender sees that a building is getting its roof repaired or in the middle of giving a roof repair, it doesn't want to go ahead and close, because you don't have anything. You don't have certificate of occupancy. You don't have several things done with permitting. Hasn't gone through its own structural test. So it puts the lender at risk, puts everyone at risk, right? And until that roof has actually been capped off and everything's fixed. So if you are a condo owner right now and you know your building is going through these assessments and you're trying to sell, you don't know what to do. You need to get out from underneath this property, but you don't want to lose your equity. It's very complicated. It can be very confusing at times. There are ways to go about selling your property depending on your position in your real estate portfolio and where you're trying to go. The thing is, you have to understand timing specifically for the example I'm about to give you, and I'm going to ask Tony to weigh in as well. So, for example, let's say that this is actually a scenario I have currently. You have a seller who lives in a condo, over 55, a senior citizen, and they want to move because these assessments are going to be too expensive for him in this example. He doesn't understand the new laws that have passed because they are so new and there is so much that's still unclear, but he wants to cap out because we are at the top of the market and he wants to take those funds and reinvest them elsewhere. Totally understand that. This is what I had to say to him. Okay. And you can feel free to take notes, viewers, and give me your opinions in the comments below. Would love to get your insight. He has about $137,000 in equity in this condo. Okay. He does have a mortgage on the condo. When he sells the condo, he's going to have to pay the mortgage off. After that's said and done, he should take home about 117,000 if I have my notes correct in my head. But he wants to leave like tomorrow, because they all do. You want it over with. Moving's a pain in the assets. No one wants to stay. It's everyone wants it over. So how do you attract buyers into a condo at this point? Well, people typically at his price point and going into condos you're attracting a lot of cash buyers. But cash buyers don't want to go into with the assessments being as crazy as they are right now because they don't know where they're going to land. If your condo building doesn't have all the quotes that it needs, if it doesn't have all of the reserves funded that it needs, there are a lot more wild cards at play. So how do you entice a buyer to buy your condo over another property? This is what I suggested to him, and I would like you guys to put this into perspective. He does have equity in the property. He doesn't need all of his money to move. He needs some of his money to move. We have put together several strategies. One of them is by creating a lease option and a purchase option. What does that mean? Well, he is going to either rent out his unit with the option to buy at a stated time for a stated price from the effective date of the lease, or he can do a purchase option, which is bilaterally binding, meaning both parties have to act for, again, the same price at a stated period in time. He, for example, is willing to carry, say, a $50,000 seller's note to incentivize someone to come into the property, and he can actually make interest on that note. And while the repairs are getting done in the condo, the person that's living there can actually benefit in the equity when it's structured correctly through the attorneys. Now, that being said, how would he be able to hold on, let me rephrase my statement here because I have it half written down right here. How to use HTH with condo. Okay, so now let's say that someone moves into that condo. They are the tenant. They have the option to buy the property. How can they leverage the Hometown Heroes program to purchase this property and buy it off of the seller?
Well, number one, they can't exercise the Hometown Heroes program until they actually enter into a purchase contract with a specified closing date, because your Hometown Heroes money comes at closing.
Perfect.
It doesn't get allocated and set aside if you're going to wait 6 months or 9 months to close. It's being utilized by people who are actively using the funds. So with the presumption that there's funds available when your borrower in that lease option position exercises the opportunity to purchase, it is then that his Hometown Heroes funds would have to be requested, determined, and then allocated for him or her.
That's brilliant.
Now, we have other options, though.
Tell me.
Well, you could take a private loan temporarily and then exercise a refinance to a better program once the structural repairs are done.
So this is a private money loan, correct?
Yes.
And can you talk about the difference between Fannie, Freddie, and a private money loan?
Well, a private money loan is going to be a considerably higher interest rate. However, it will give someone who needs to be in the home, it will allow them to file homestead potentially on the property. So they're now capping their tax base on the property. And then when the structural work is complete, they can then refinance into a more desirable loan. That's an opportunity. You don't often find those situations in adult communities, not often. And back to what you had mentioned earlier, more often than not, the mature audience, like Century Village buyers, are leaving those communities simply because in order for all of those condominiums to meet the new requirements, they're raising the monthly association fees, and often they are on fixed rate or fixed incomes, and they cannot sustain a lifestyle that's even
Remotely affordable.
remedially
Okay.
possible with the elevated association fees. So this is a dilemma that does have to be overcome. But also, if the value is there, you can sell it at its highest possible value and then give a credit toward closing costs and prepaids if that is an opportunity to help someone trying to get into a property that he or she may not otherwise be able to.
I actually want to take this opportunity because that was fabulous information. I think what I wanted to show where there are multiple ways of overcoming these challenges when you have a professional team of experts to help guide you through the home buying process. You see, these buildings are already in existence. And if no one comes up and actually goes into these buildings and tries to become homeowners here, the buildings are going to continue to dilapidate, and it's going to get worse and worse and worse. So if there is a way for someone to go into these properties, whether they're a young couple, the starting family, an individual buyer, or even people who are older and more mature, in your words, if there is a plan to get them into the property safer with an exit, including a refinance down the road, it would make sense to examine these opportunities for you. These buildings have a lot to offer. Just because they are condos and they're being forced to meet the reserves now because of a government mandate, you should not be scared of it. You should examine it. Just make sure you're aware that it might be more cumbersome. There might be more steps, but the end game could be incredibly powerful and lucrative for you if you play your cards right. So that's what I wanted to say on that note. I'm trying to think if I had any questions written down here real quick. I don't believe I do. Is there anything else you'd like to share with everyone, Tony, besides how we'll tell them how to get a hold of you in just a minute, but can you also talk about anything else we need to know as far as programs coming down the line or other avenues people should consider when they're trying to buy their homes right now in the state of Florida?
Well, selfishly, I'll share with you that we are the largest product and program lender in the country, which is advantageous because we have more opportunity to offer. But some of the services that we help buyers with is once you become a client of ours, we will have a team analyze your real estate taxes. And if there is any opportunity to save the borrower money on the real estate taxes, we provide that service for free. In conjunction with that, we are devising and developing a program to incorporate student loans into the mortgage so that borrowers can relinquish themselves of their student loans and lessen their payment because it will be less amortized over the life of a loan than it would be as a student loan.
Okay,
So we're working on
now I want to have another conversation here. You're talking about student loans. I think I know a thing or two about this now. Okay, say that one more time and more slowly for those of us who went to a public university.
So when you finance a home, assuming your credit report shows that you have student loans, the requirements for counting the debt on a student loan are stringent. Often you have to take 1% of the student loan balance. So if you have a $50,000 balance on student loans, you would have to take $500 a month as a payment. Well, adding $500 a month to someone's debt ratio could be detrimental in his or her ability to qualify. But if we were able to remove the $50,000 and incorporate it into the loan that's amortized over 30 years, it might make what would have been a $500 utilization payment to qualify. It might have brought it down to $175, which now gives the borrower or the buyer considerably more purchasing power because the payment on the debt ratio is lessened.
I have to call all my friends after we're on the phone. I got to
Now,
call everybody.
the program isn't finished. It's in development stages.
Oh, so we're getting a sneak peek?
You're getting a sneak peek. And I guess my premise for sharing with you is we are constantly looking for ways and opportunities to help consumers get into property or obtain property or have home ownership. And these are just some of the things that we are looking to devise and create to facilitate that possibility.
This is so exciting. Like I'm actually geeking out a little bit right now. Hold on, let me contain myself. I'm trying to act professional. I might just have to be professional adjacent for a second. This is really exciting. So all of our friends, because I remember when I got my first property with my former partner, I couldn't qualify for the mortgage because of my student loan debt.
That's
It was
right.
because of that in particular. So he had to carry the note on his own, which was caused other issues we had to overcome. But now you're saying that there are programs in development, they're not here yet, but they're in development, where people can actually roll their student loan debt into an actual tangible asset that goes up in value over time, that ultimately could be refinanced to pay everything off. But either way, they're removing this weight of a monthly payment around their neck,
That's right.
reducing the monthly payment and still growing their net worth.
In theory, that is correct. And
I need a minute for that. I
I
feel
will,
like I need a cigarette after. That's going to be really good. I don't smoke, but that sounds. Where is that? When is this coming out?
well, we're waiting. We're working with some insurance companies who have to securitize and insure that piece of the loan. So there's a considerable amount of work that goes into these type programs, but I have a plethora of programs that we are going to start working on, all with the intent of helping homeowners obtain their American dream, or buyers obtain their American dream of home ownership. And I think that's one of the advantages of working with a company like us, one that is innovative and desires to create opportunity for borrowers.
This is literally what you just did. And I hope people are seeing this. In this one episode, you have mentioned at least 3 different ways for people to come from never owning a home, from being terrified of getting into it, from having all these barriers that keep people traditionally from being homeowners, to actually creating a path of raising their net worth and building generational wealth. This is really, and I did not know this was a thing. I very rarely get flabbergasted, so you have to give me a minute. I'm trying to pull it together here. Give me a second. I'll come back to it. But that's really exciting. I can't wait to find out when this will come to be.
Well, we're working on it, and I'll share with you that our premise and our mantra will be, and always will be, we are here to provide a service for the traditional and non-traditional borrower. We are not here to just finance a home for you, but provide you with a service.
So would you mind, I want to cover one more thing before we end for the day. And you've been so generous and so gracious to come and join us and offer your time and expertise. You mentioned a minute ago the different limits when I used my example, and I want to make sure I clarify my example of 500,000 for an FHA versus conventional. Would you mind real quickly giving us some of the limits that people need to know about when they're doing an FHA, a conventional, hometown heroes? What are some of the basic limits and requirements that they need to go to? Or can you tell us how they can find that information?
Sure. Well, you can always go online and Google the limitations, because they are county specific. Each county has its own limit for an FHA loan, and you have to typically look. Now, there's a different number that will show for a single family home. There's one that will show for a duplex, a triplex, a fourplex. So you have different varied numbers specific to the county that the borrower chooses to purchase in. In addition, on a conventional loan, you go by the federal amount, which is $727,000. After that, it becomes a jumbo loan. However, in certain areas of the country, they have what's called high balance loans, which means they're areas specifically structured where the loan balances are higher. So they call those high balance loans, which is not necessarily a jumbo loan, but not necessarily a conforming loan. It's sort of in between. So there's different structural pricing that takes place based on the category into which you fall. You'll often find high balance loans in states like California, New Jersey, states like that. And then what might be an FHA loan in Broward County, the limit of 400,000 to 500,000 will be dramatically different if you go to Georgia or Tennessee or South Carolina. So you really have to be very specific to the county, and to be even more specific, Orlando or Orange County might be dramatically different than Broward or Dade County.
That's for sure. You wrote that all that. I was trying to keep up with you, and I think I got most of it, which is wonderful. What I want everyone to take away is there's so much more to this than just, hey, I want to buy a condo, I want to buy a house myself.
Sure.
There's so much more here, and you are such a wealth of knowledge. I can tell you not only take pride in what you do, but you enjoy what you do, and it just makes working with you quite delightful. So thank you. Tony, hope you don't mind. I put your email down here at the bottom of the screen so people know how to find you right there. Yep. Tony at premiermortgage.com. That's ntg.com. And is there any other way you like them to reach out to you, social media?
Everybody's welcome to call my cell phone, and my cell phone is 954-328-7662. And it is my pleasure and my team's pleasure to serve anyone we can.
I've also put that number down here on the bottom as well. So you can reach out to Tony at premiermtg.com. You can call it on a cell phone down here. And you can also reach out to me, Jacob Jennings. I am a real estate broker with Balistreri Real Estate. You can reach out to me at jacob@jacobreed.com. I'll put that on the screen as well. So jacobreed.com is my website, and my email is simple, jacob@jacobreed.com. And I'll be glad to help you navigate your real estate journey. Remember, you need a strategy. Your first home purchase should be just that, your first, not your final. And as you go through navigating today's market, which is uncertain, what are you doing to position yourself to safely and securely grow your portfolio and diversify, but maintain your real estate? I would love to be of service to you. Please reach out. Also, I want to take a moment to mention what I'm wearing today. For those of you who don't know, I started a nonprofit called the Sherlock Holmes Foundation to help youth who were experiencing homelessness during COVID. We are now in 3 states, Colorado, Richmond, and Virginia. We help any vulnerable population that's out there. We're trying to make a difference in changing the conversation around homelessness. So if you would like to get involved and change the conversation around homelessness, please go to sherlockshomes.org. That is SHERLOCKS.org. CKSHOMES.org. Oh my gosh, I just butchered that horribly. I'm going to type that out because that was just ridiculous in my own organization. But find out how you can also get involved and see what we can do to make this world a slightly better place today than it was yesterday. And of course, there's a percentage of every one of my sales actually goes to charitable causes. So if you're interested in having a broker help you make an impact with the transaction of your property, please let me know. I would be delighted to serve you. I believe that's everything I wanted to cover today. I am so glad that you took the time to talk with me, Tony. As always, I've learned a ton.
It's my delight to serve you, my friend. I'm happy to be here.
Well, thank you everyone for joining. Please like, subscribe, and share this video for people you think might need it. Anyone who is curious about that student loan program that might be coming up here with your mortgage, you better stay in touch. You bet your ass I'm going to get him to talk more about this. All right. And we're going to do it as soon as we can. Tony, thank you so much. And you have a beautiful day.
And I wish you the very same. Thank you so kindly.
Thank you, everybody. You are flipping fabulous.